regular pension board meeting. It's February 25th. Call to order. Roll call, Madam Clerk.
Nick Curry.
Here.
Dan Jansen.
Here.
Christine Hoffman. Brandon Maresma. Jennifer Rutolo. David Cohill.
Here.
John Patrich.
Here.
Matthew Grocke.
Here.
John Costilla.
Here.
Jason Sharp.
Here.
George Candler.
Here.
Ed Dawson.
Here.
John McDaniel.
Here.
Lance Hewish.
Here.
Debbie White.
All right. Next up, courtesy of the floor to all of our visitors. I guess there's none. And then items for discussion, approval of minutes. Let's start with the police officers board. I need a motion in a second.
Motion. Second.
All in favor, approves, say aye.
Aye.
Aye. Aye. Any opposed? Motion carries. Firefighters, first and a second.
So moved.
Second.
I got a first and a second. All approve, say aye.
Aye.
Any opposed? Motion carries. And general employees, get a motion in a second.
Motion to approve.
Second.
I got a motion and a second. All in favor say aye. Aye.
Aye.
Any opposed? Motion carries. New business, consideration by general employees, police officer, firefighters, board of trustees, consultants, reports, and presentations.
So first up is Brad Armstrong with GRS Consulting presenting the 5-year actuarial experience review quote that he has for all three boards. They are separate amounts, and we'll let you take it over, Brad.
Okay. Can you all hear me?
Yes.
Okay. Great. We haven't done an experience study in a number of years. The Government Finance Officers Association, abbreviated GFOA, recommends that you engage the actuary to perform additional services to validate the actuarial assumptions used for the valuation or to help the plan with risk management strategies and future trends forecasting. In addition, we have the Division of Retirement, who periodically will request an experience study to bring the assumptions in line with recent experience. And your auditor may request those assumptions be brought in line. So there's a saying amongst the actuaries that things change and our understanding of things change. So these studies would look at, it's covering the period of the pandemic, but primarily the pandemic impacted mortality, and mortality is statutory in Florida. So we don't have to reflect an analysis of the mortality table because you'll be adopting the Florida Retirement System mortality tables this year. The assumptions that we are going to look at are investment return and price inflation. Those are economic assumptions or things that happen to money. If I didn't mention this, we'll look at, interestingly enough, if you do a 5-year experience study, you actually need 6 years worth of data because you need the beginning of period, the 2019 data, all the way inclusive through the 2014 data. So it's analyzing 6 sets of data, retirement rates during that period, withdrawal, some non-vested who become eligible for a refund of member contributions, and vested terminated members, they actually have a percentage that may forfeit to elect a refund of contributions, and the remainder become vested terminated members eligible for a deferred benefit. pay increases due to merit, seniority, and step increases, disability rates, actuarial methods, which include the asset smoothing method that we use for the purposes of determining the assets available for funding the defined benefit promises that are being made, the actuarial cost method, and the amortization policy. Those are all things that would be included, and we recognize that all three systems invest together, although the firefighter system has a rate of investment return assumptions that by the interlocal agreement is required to match the Jacksonville Police and Fire Pension Fund assumption. But nonetheless, all of the assets are invested together, and it's appropriate to assess the reasonableness of the assumptions collectively with regard to the entirety of the assets that the combined three retirement systems have. So the consulting fees associated with the general employees would be $6,500. They're the biggest system with the most members, so it's a little bit more than police officers. The fee quote is for $6,000, and the firefighters is a closed plan, so there's a little bit less activity. There's no need to analyze new members. I suppose it's possible that there could be a rehire that may become eligible somehow, but that's very unlikely. So the firefighters would be $5,000. There any questions on
Any questions for him? No questions from our end.
well, we think it's appropriate, and if you use the same assumptions for too long, you could be deviating away from your funding target and not realize it. So we think it's a valuable exercise, not too often, but we're not we're not in that situation at present. It's been a few years.
Alrighty, thank you, sir. Any more questions for him before we allow him to go? None? Thank you for your time, sir. We're going to go ahead and move to approve GRS Consulting 5-year actuary experience review quote. We'll take it one board at a time. We'll start with our police officers. You need a motion and a second.
Motion.
Second.
Madam Clerk, roll call.
David Cohill,
Yes.
John Patridge,
Yes.
Matthew Grunke,
Yes.
John Gostilla.
Yep.
Jason Sharp.
Yes.
Thank you.
Motion carries. Firefighters, motion and a second.
Motion to approve.
Second.
Madam Clerk, roll call.
George Candler,
Yes.
Ed Dawson,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes.
Motion carries. And general,
Motion to approve.
Second.
got a motion and a second. No comments or questions. Madam Clerk, roll call.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Jennifer Rotolo.
Yes.
Motion carries. Moving on to Brendan. I think you're up
Well,
next. Sorry, go ahead, sir.
I apologize. There's not a requirement that the assumptions be adopted consistent with the 2024 actuarial valuation reports. We typically, 10 or more years ago, we used to present our reports in August, but we published them a lot sooner than that. With the experience study, we wouldn't necessarily be able to finalize the actuarial evaluation results until the board meets in May. I think you could do both and make the decision at that board meeting, but I just wanted to make the boards aware that those were the experience study reports, which will be completed between now and the May meeting, are a requirement that you adopt them coincident with the 24 report. You could postpone until the 25 report, depending on how the results look and what the board's collective inclinations are. And with that, so that I don't put finance into a panic, we'll have all the information we need. When we leave the May meeting, we'll know what the contribution requirements are for the 25-26 fiscal year.
Very good. We'll be looking forward to that then.
Okay, appreciate you all. Thanks so much.
Thank you.
Okay, bye-bye.
Brendan, the floor is yours, sir.
All right, good afternoon. Everyone should have a hard paper copy in front of them. Do you want me to also do the electronic and page through? Or is it, do you need that? Probably should.
Yeah, let's go ahead and do that.
Do it in case,
Yeah, just
for the
in case.
record. Okay.
Yes, sir.
So I'll start on page number 4, just to kind of go. Well. Oh, okay. I'm gonna start on page number 4 to kind of review the market environment. One thing that, and I'm in the upper right-hand corner. The one thing that's kind of misleading about this page or hidden on this page is there was actually a ton of volatility within the quarter. So if you look in that upper right-hand portion, you'll see the S&P 500 was up 2.4%. The other large cap benchmarks, the Russell 3000, the 1000 were also up 2 and change. Mid cap and small cap were up, but less so, only up 0.6 and 0.3% respectively. Now, what you'll see in the orange bars are the international stocks, and they were down somewhere between 7.5% and 8% or so. With really the big item being the topic or the discussion around trade tariffs. Once we got post-election and the tariff discussion really started to gain steam, we saw the dollar really increase in value, and then obviously it just presents a lot of concerns about trading activity and tariffs and so on, so it caused a lot of pressure within the international markets. The last section down at the bottom, fixed income, you'll notice that the broad indices were down about 3%. For the quarter. The vast majority of that was in the month of December. If you might recall, the market had been expecting interest rate cuts. We've been getting them in the second half of 2024, and the expectation, call it in middle of November, was that we'd get somewhere maybe 3 to 4 cuts in 2025. The short version is the Fed in early December came out and said, and I'll paraphrase, the cuts you thought you were getting next year is probably not going to happen. And so the market, and bond market in particular, really adjusted. And from that moment on, we saw rates in particular on the long end of the curve really move up. And we'll look at that in more detail in just a second. So again, I was referencing the S&P 500 up 2.4%, but the other thing that I want to show you down on the next page, page number 5, looking in the upper right-hand corner, huge deviation between growth and value. A lot of that deviation also coincided with the change in tone about interest rates. Expecting cuts, now we're not really expecting as many cuts. Growth did very nicely, up somewhere near 7%, depending on the benchmark, where value was down about 2%. So again, big deviation. And then obviously it was even a greater degree in the smaller cap stocks. The smaller cap stocks did not do quite as well. I'm going to skip the next handful of pages. If we go to page number 11, just to put a chart or a picture behind what I was talking about with interest rates. Sorry, I'm just making sure the electronic is catching up. There we go. Sure, that's great. So I'm down in the bottom right-hand corner of page number 11. Now let's contrast the yellow or the orange bar line where we were at the end of the fiscal year 9/30. You'll notice the left-hand dot was the highest point on that curve, and then it sloped down. It eventually makes kind of a U shape, but overall, the left-hand side of the curve was higher than the right-hand side of the curve. Really, for about a year and a half to 2 years, we've been talking about this relationship where short rates were higher than long rates, and we call that an inverted yield curve. And very simply, I describe that's the way the bond market feels about the future, or the slope of that line is the way the bond market feels about the future. So if rates 2 years from now or 4 years from now are less than today's rates, it's kind of the bond market saying we think tomorrow is going to be worse than today. And recession is typically the word that's thrown around when you see an inverted yield curve. But we've been through an inverted curve for a couple of years, haven't seen a recession. Here now in the month of last December, the Fed comes out, says you're not going to get as many cuts as you were thinking. So we saw the long end of the curve really move higher. So if you look at that blue line, now you will notice on the left-hand side, the dot did drop pretty significantly because the Fed did cut a few times within the quarter. But again, that guidance going forward was not as many cuts. So you'll notice once you get out past that 1 year curve as you're moving to the right, all of those rates rose pretty dramatically. Again, reminder, bond prices move opposite of interest rates. So when interest rates are going up, it means our bond prices are going down. So that's sort of the pain point. That's why we saw that big negative 3% quarter, because of all those longer rates moving higher. The one silver lining, now if you look at the slope of that yield curve, it's not dramatically positive, but it does have just a little bit of a positive slope to it. So it took a little bit of a reset, some negative performance, but now the bond market is kind of signaling they think tomorrow is going to be a little bit better than today. So again, a little bit of a mixed bag, but just wanted to point that out, that we're really not inverted for the first time in a few years.
On the chart right above that one, look at July 24, that little glitch. What was that indicative of? Do you know?
You know, I'm not sure. I mean, so the yellow line, it's the high yield or lower quality bond option adjusted spread, and it jumped. And I'm just trying to think what happened in July that would cause spreads to kind of spike. And then,
Right, the red one did slightly as well.
yeah, I'd have to go back and look at it. I'm sorry, I don't recall.
Not a big deal. Just curious.
So with that, let's go ahead and jump to page number 14, where we kind of really review the history of the fund in one singular snapshot. So as a reminder, page 14, we have your data going all the way back to 1987, when the plan was under $12 million. The blue bars along the bottom represent your net cash flow. So any money that comes in, whether it be contributions from the city or contributions from the employees, any money that would have been coming from the state, all comes in, minus anything that comes out for benefit payments and expenses. And what you'll notice for the first 10 to 15 years or so is those blue bars were actually going slightly higher, but they were relatively stable. And then right around 2000, they started to really kind of fall off, meaning we began to pay more out in expenses and payments than we were bringing in contributions. So then in roughly 2009, it actually turned negative, and now we're negative $39.1 million. So of the, call it $12 million you had in 1987, you spent all of that plus an additional $39 million. Yet your market value is that dark blue line, now sits at $126.7 million. So the gap between that market value and the negative $39 million is the collective gain on the investment over that period. And another way to say this is, as in particular with that line growing, so your market value is going up at a faster rate than you are paying out that negative cash flow. So it's sort of that self-sustaining point. You build up a nest egg in a pension fund, and it grows enough to pay out that what we call negative cash flow, or that benefit payment. It's really kind of the sweet spot of pension investing. The other point that's just illustrated on this chart, we have the hypothetical investment of your assumed rate of return, which is most recently at 7.5%. Previously, it was at a higher rate. But so had you just invested that $11.8 million and gotten the assumed rate of return, you'd have $109.8 million. But instead, you have, again, that 126.7 because you've beaten the assumed rate collectively over that period of time. Let's skip ahead to page number 17. Just a quick snapshot of the asset allocation relative to policy. Those blue bars represent the deviation from the target. And what you'll notice, we're actually just slightly underweight in equity now as we rebalanced the portfolio, took away some excess, and after that did have some negative performance. So we are just slightly underweight as of 12/31. But in the grand scheme of things, looking very good relative to policy and to target. I reran the assets as of yesterday, and equities are up now, so you're essentially really spot on the target allocation as of today. So with that, let's jump to page 21 and talk about the actual results. So although the S&P 500 was positive, again, most of the other indices were negative. And what you'll notice, we did overall have a negative result for the quarter. So we were down 56 basis points, but you placed in the 39th percentile. You outperformed 61% of the public funds for that 3-month period. Our policy was down 62 basis points. Again, or so a slight outperformance, although it was in a negative environment. For the 12 months that was 2024, we had 13.3% versus the benchmark of 12.28, and again placed in the 12th percentile. So for the year 2024, did better than the vast majority of your peers. So obviously a very nice result. And if you look out over the longer periods, 5 years, 7 years, 10 years, you can say how you're ranking, well into the upper half of the universe. And I would also say that's with quite frankly, a lower equity allocation than most. So on a relative basis, scoring pretty highly in that peer group with a more conservative plan allocation. As we move down on page 21, we've got the Vanguard Index Fund did exactly what it's supposed to. We still do have the Allspring Growth Portfolio. Now you've made the decision to move on. I guess I'll pause here and give you a little bit of an update. The process is taking a bit longer than we had expected in terms of the application process. We were kind of given guidance in the beginning because of the situation with the city, tax ID numbers, and so on, that the investment sort of needed to be registered as the retirement system as a whole. And so that was the process we went through. And then ultimately, they reviewed that against the IRS documents, and each plan has its own tax determination letter. So it essentially got kicked back because if each plan has its own determination letter, then they need an application for each plan, even though the investment will ultimately be a collective single pool like all of the others. So again, the process has just taken a little bit longer than we expected because of that back and forth. But one little bit of, again, sort of a silver lining, the Allspring portfolio, although behind the index at 6.4 versus 7%, the Winslow portfolio was less than 5% for the quarter. So did get a little bit of a performance differential there by that delay. JP Morgan Equity Income did exactly in line with the index, although it is behind for the year, 12.8 versus that 14.3. And then Eaton Vance, our small mid-cap, down almost 3% versus a positive 62. Although you'll notice for the year, 13.7 versus a positive 12. So kind of had a really poor quarter, but gave back. We essentially were giving back some of the gains that they had previously in the year. So again, still overall a very good result, but a little bit of a flip there. Page 22, we've got our international portfolio. So collectively, I guess the good news is the portfolio was down less than the benchmark. The 3 funds were down 6.58 versus the benchmark of 7.5. DFA Value, the new fund, was down about 6%, but again, that was well ahead of the 7.6 of the benchmark. And then the Euro Pacific and WCM were both down 7% and change, again, slightly ahead. So each manager did better than the benchmark, but by varying degrees there. Then we get down into the fixed income portfolio. the total line, we were down 2.88 versus the benchmark of down 3.20. The Baird short term did nicely. You know, again, the left side of that curve, as we were looking at a few minutes ago, didn't really see much adjustment. So that short portfolio actually had a slightly positive result. But Sawgrass, which is again longer duration maturities, they go much farther out on the curve. They were down essentially in line with the index, 3.2%. For the year, positive 165 versus a 1.07. So again, outperformance, but in a certainly a more volatile environment and giving back some of what they had earned previously. The last fixed income piece is our PIMCO diversified income. There was down 61 basis points versus the policy of almost -5. And on the 1 year, 6.4% versus a -1. So relatively speaking, certainly very nice performance there and adding return above and beyond what our domestic bonds had earned over the 1 year. And then the last piece is the JP Morgan Real Estate Fund. Again, we are in process of slowly working our way out of that. We do have a nice positive quarter of 1.7% versus the benchmark of 1%. Although for the last 12 months, it is still negative, down 1.7 versus roughly 1.7 for the benchmark. The good news is, you know, really most real estate portfolios have negative returns or writing down their portfolios for the last 18 to 24 months, and we're starting to see that kind of stabilize. Not really writing down, even getting some positive results like this. So at least the hope or the expectation is that will again stabilize, and not to say that we're going to get 15-20% out of real estate anytime soon, but stopping those negative results and at least being able to collect the income and perhaps get a little of that appreciation certainly will help the plan, because again we have not been seeing that positive performance over the last number of years. Let me pause there, see if anyone has question, comment, or...
You still in line for JP Morgan?
I'm sorry?
Are we still in line to get out?
Yes.
Okay.
But it'll be a slow process. Just to sort of set expectation, I know you've got a very full agenda in May. So my thought is maybe in August to kind of begin the review process, to begin to look to that kind of ultimate replacement. But there's really not much of a rush, because again, JP Morgan's been sending 1, 2, 3% of your investment back on a quarterly basis. So we have a little bit of time. There's no need to kind of rush to try to make that replacement situation. Obviously if something changes, I'll make sure to let you guys know, but we've got a little bit of time, and again, I would anticipate maybe at the August meeting, kind of being prepared to start that discussion.
Perfect.
Brendan,
Yes,
did I hear you say we're in the process of getting rid of real estate?
exiting that investment, correct.
Okay.
Again, not to eliminate the real estate position, but just to get out of JP Morgan. But
Okay.
the pace is going to be rather slow. So just, essentially taking a few quarters before kind of jumping into the replacement decision, because we might be in a position where, you really haven't redeemed any of the money out, and then you hire somebody else, you potentially over allocate because you haven't received the old money.
Yeah, okay. I was just making sure I heard what I
Sure.
heard right.
Then just by way of a quick update, I kind of mentioned the asset allocation, but in dollar terms. So I'm looking back on page 16 because that's where I wrote my notes, but it's not in your book. We're at $126.7 million, again, just as a reminder, at the end of the year. As of this morning, you're at $128.9 million, which is on a market value basis 1.76% above the balance on 12/31. So again, if you go back to the quarterly number of down about 0.5%, and then you add 1.7 to it, we're sitting at roughly 1.25% or so positive on the fiscal year to date basis as of today. Any other questions?
No other questions?
No.
Does that wrap up your,
That's everything I had for you today, yes.
okay. We will, move to approve the, quarterly investment performance report from Mariner. Start with the police officers. Motion and a second.
Motion. Second.
No questions, comments. Madam Clerk, roll call.
David Cohill,
Yes.
John Patridge,
Yes.
Matthew Grocki,
Yes.
John Gostilla,
Yes.
Jason Sharp.
Yes.
All right. Motion carries. Firefighters.
So moved.
Second.
Got a first and a second. If there are any questions, comments, Madam Clerk, can I get a roll call?
George Candler,
Yes.
Ed Dawson,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes.
And general employees. Motion and a second.
Motion to approve.
Second.
No questions, no comments, Madam Clerk, roll call.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Jennifer Rotella.
Yes.
Motion carries. Now the next thing on the agenda is possible action, Brendan, in reference to adjustment, rebalance of or allocation of assets.
I think that's kind of a placeholder to the, to the extent we need to do any rebalancing or anything's out of line. But in the report, I mentioned how we were essentially spot on with all of our targets, so there was no need to take any action.
Thank you. All right, moving right along. Dustin, is the pension administrator's reports and presentations.
Thank you, sir. Bit more in my pension administrator reports this time than I normally have, but at the FPPETA conference, for one, just want to let the board know that we are getting something out of going to these meetings and that they are providing some good education. So I just wanted to let you guys know some of the things that came up at the last meeting. The IRS has issued some statements about duty disability recipients and what portion of their pension is taxable. It's just kind of been this vague thing in the past where if somebody was on duty disability, everybody just put zero, even though there was this IRS guideline out there that's this complex formula about what portion of it is actually taxable. And it's just never been one of those things that's gone, 30, 40 years and never been enforced. And so they put out a statement saying, hey, we're going to start looking at this. So got to get with finance and over the course of this year and make sure by the time we get to the end of the year that we are reporting everything correctly for our recipients, because we don't want them to be caught off guard by this either. Speaking of duty disability, Pedro was actually giving a presentation, Pedro Herrera, at the FPPTA conference where he mentioned, the need for plans to be verifying the duty disability status of their duty disability recipients. And that's not something we've done in the past. And so I reached out to Pedro and had him ask him to create us a form. He's done that and provided that to me. And so we're going to be sending those out to our people very shortly. So if you get any questions from, some duty disability recipient, just, it's just kind of a process. We're not trying to catch anybody or anything like that, but I'm just, if I had been receiving a pension for 20 years and then all of a sudden I get a letter and want somebody to take me, to go to my doctor and verify that I'm receiving, that I'm still disabled, I might think what's going on here, but we're just doing what we're supposed to be doing. So.
Is it just the duty disabilities? Is that the only one they're targeting, or?
It right now it is just the duty, or that is not true. It is the disability recipients. We have them for all disability, not just duty.
Not just, okay, because
It's
there's
all
non-duty
disability
also. Okay.
recipients. Sorry, I misspoke.
Is that annually? Or
It is annually.
who's paying for that? Them?
There's, yeah. I mean, it's on the.
Because that's going to be
recipient.
asked. That's what I'm asking. If we're forcing them to go get something done, is that something that if they can't afford it, or how's that going to work out?
I don't know. I haven't been down this. Haven't been down this path yet. I didn't think to ask Pedro that question. would hope that would be part of some sort of annual checkup, that because it's no more than just a form saying, yeah, I'm still disabled, as I have been. So I don't know. We're not asking them to write a letter or anything. Just sign the form that we're sending with the Pedro's verbiage on it.
Could you get clarification for us?
What's that?
Can you get clarification for us by the next meeting from
Sure.
Pedro?
Yep. Let me just make a note of that. All right.
They may have to do that anyway if, for, that. Get
They,
that.
they
Yeah.
may have to do it already for, if they're on our disability, it's likely they're on Social Security disability and they're already having to do it. So,
Yes, hopefully that'll work. They
Maybe.
have to do it anyway.
Yep.
It won't be an extra expense.
another thing that came up is securities litigation monitoring. I went to 2 different presentations on that, mainly because David had mentioned it a couple meetings ago, and then asked Pedro about it, and he said, "Yeah, it's something we should be looking into." And then I go to this conference, and at these meetings, there were a few of us in there, and we were the only board in there that did not have securities litigation monitoring services from at least one attorney of all the people in there. So definitely think it is something worth looking into. Pedro has recommended 3 separate firms. And from what I gathered from our meetings, it's not something where you just go with one because they specialize in different areas. You can go with at least 2 is what the recommendations I've heard is. Now, at the May meeting, Pedro is going to be presenting these 3, if not more, and why he believes that we should do this, which firms, all that kind of stuff in more detail. I just kind of wanted to prep you guys on that it's coming and kind of what it is. But I mean, it's basically just that there's lawsuits for a company that they've had fraud or misuse, abuse, something like that. That if we were invested through equities generally, then they can possibly recover some money for us. Now, they say it's 0 cost. They still get paid. It's just we're not cutting them a check. It's just they take a portion of whatever they recover, and that portion, as I understand it, is set by the judge and whatever they deem is fair. So, we'll get
Brendan looked
more
like he wanted to add something in there.
I just saw it seemed a little concerned. So having not had a securities monitor previously doesn't mean you're not participating in in these classes. So Salem Trust is going to get notified, of these different things, and they're the one that kind of certify, oh, hey, we owned security XYZ during this case, and so you'd still participate. But this is sort of an extra level of monitoring where you have these firms that are actively tracking your portfolios and then comparing them against, and ultimately, with plans of your size, it's unlikely that they'd ever ask you to be a lead plaintiff or anything like that, but it could happen that if you had a substantial loss above and beyond what other plans might have, they might reach out and say, hey, we think you've got a good case, and ask you to be lead plaintiff. Again, I'm getting down into the weeds of it a little bit, but I didn't want you to, it just seemed like maybe like, oh, wait, we've never participated in any sort of class action. No, you've been able to just by virtue of owning it and Salem Trust filing on your behalf. But this is sort of just another level of oversight.
Thank you.
Moving on, the FPPTA conference coming up in June. We'll be at the Omni Champions Gate. If you're interested in going that, please let me know, because by the time we have our next meeting, it will already be open, and that's the conference that fills up the quickest, the summer one. So, yeah, if you're interested in going, let me know. That way I can sign everybody up as soon as it opens, because it's a real pain to not stay at the hotel where the conference is.
Dustin,
Yes.
real quick. to go back to the pension disability verification,
Mhm.
it says in there, it says you can see this form attached. Is it in here at all?
Say it again.
The form says that it's attached into this? I don't see it in there.
I will send that out to you guys. I meant to attach it, obviously. I did include some the securities litigation, just kind of an info packet from one of the this one in particular, the Saxena White did give a pretty good breakdown on what it is, how it works, and so I included that packet not to promote them, but just because I thought it was a good breakdown of what it is, and then there's a sample agreement there at the end, which actually came from a different provider.
Just to clarify, they did state that a lot of those different pension boards have multiple litigation firms. So if Pedro is saying there's three of them that he recommends, is there a reason why we shouldn't go with those three and just have them all stacked, or is there a reason why we should just pick just one?
Like I was saying, nobody in that room only had one. They all had multiple. So, and after I talked with Pedro after one-on-one, and he recommended at least two.
Right.
So 2 or 3, I think is probably going to be. But that's not for me to recommend. I mean, I would just let him comment more on that.
Of course.
In the May meeting. I will send that out in an email as well, like I said. The death audit software, it worked pretty well for a few years there, and until it didn't. Here in December, I ran the audit, and it picked up 2 people. I run it every month, but it picked up 2 people, one that had been passed away for 10 months and one that had been passed away for 5 months. And neither of those families had let us know that was happening. And I don't know what happened to the funds, but the funds are no longer in the accounts. However, both of those families have agreed to pay back those funds. But it just kind of highlights the need to get better monitoring software. We're kind of paying for the lowest level, which I thought was a good deal at the time. It's only $600 for all 3 boards annually. So, I mean, relative to how much money we pay out to our beneficiaries, it's insignificant. So the next level up, or to where I believe from some other quotes I've got, is somewhere between $2,400 and $3,000 a year, which again is fairly insignificant for how much we pay out. So that in our next budget, I'll be asking for that increase in our death audit, which I'd kind of asked for before, but because I thought we were going to have to go up, but we were able to continue on the lower level. But
Dustin, can you explain, like, how does that work, the audit? Is it based on what they provide us? What's the actual audit? If it's $600 a year, obviously it's not much, but is it basically what they provide us, and then we check on that?
I take our payroll data, who our current pension recipients are, and it's first name, last name, social security number, date of birth, middle name, and it runs it through the company that we are signed up with. They have a database of basically deaths that have happened throughout the year. They're pulling from social security database and obituaries throughout. They pull from websites and everything, and they just basically try and create a database of everybody who's passed away.
Does it connect to vital statistics?
Say it again.
Does it connect to vital statistics?
I don't know if that's I think that's the next level up that connects to the.
We do an annual verification of survivorship every year at any time.
So that's my next
next
item here.
Okay.
The proof of life we've not done in about 5 years, which is once we obtained the death audit software, we kind of stopped doing the proof of life, which is kind of what you're alluding to there. And so that has kind of left us with a gap in contact information, which is kind of an unforeseen circumstance of that. In the past, we would do those proof of lives every year, and they would notarize that they're still alive, but they would also provide updated contact information. So I'm finding that as I find out people have passed away, their beneficiary has passed away, their contact information is no longer good, and things. So I would like to start doing these proof of lives starting this year again. But how often I do them, I was going to kind of seek some guidance on that and what you guys are comfortable with. I don't know if we necessarily need to do them every year. I think that's the whole purpose in the death audit software is it's supposed to work so that we don't have to do these.
Yeah, but if it's
Every
not
year.
working, then I think we probably should.
Yeah.
We should probably reinstate it
dual.
at least until such time that you have a dependable software. I can tell you that police and fire pension fund, we still do it annually. So
Yeah, that's
it's
what's
done
on
in
the calendar
September.
there.
Yeah, the two that I'm on is done annually.
Okay.
It would be better. I could fill it out and then die 11 months later before they find out.
Yeah.
But so if they could
Well,
do
at least
it,
at least you're stopping it at 11 months and not
all they're
11
getting
years.
They're basically getting an update of where do you live
Sure.
more than anything.
All right, so I will we'll probably table that for a couple of years then, and I'll just we'll upgrade the death audit software, and we'll start doing the proof of lives again and see where we're at with some experience over the next couple of years.
They were
See-
actually
see
doing
how
a
that
pretty good job.
What's that?
They were actually doing a pretty good job until December, weren't they?
It was, but I'm still I do think we need to do the proof of life, and I think that's probably a good idea. We'll just see.
Well,
what
it's not
happens.
just. I mean, you hit the point right on the head. It's not just the proof of life, but it's also the contact information. Should something pop up at 5 months or 6 months, at least you have a point of contact for them. So,
Right.
Yeah.
Correct. I think I've hit on most everything else there until we get down to the next quarterly meeting is, I know I had
Can I stop
reference
you before you
Wednesday.
move on?
Go ahead.
At the conference in June, do they offer the CPPT classes, or is that going
That's
to be?
only the school. So the summer one is a conference. The fall and winter one is a school.
So for the benefit of our new members, can you, when you have those dates available, in case anybody wants to make any plans to attend that school to obtain their certified public pension trustee certification, make those available sooner
Okay.
than later.
Will do. They are on the FPPTA's website for future events. Everything's out there, and they've got it published for the next year and a half, I think.
All right, thank you.
But I can send that out.
I can just jump in here. The next school, which will be in October, technically starts the 5th, but the classes really start on the 6th, is here at Sawgrass Marriott.
Oh, excellent.
Oh, nice.
Very good.
So the 5th through the 8th of October.
Very good.
Very good.
Thank you.
So on the next quarterly meeting is Thursday, May 29th. I had stated Wednesday in a couple places incorrectly, where it was originally scheduled for Wednesday, but there was a scheduling conflict, and we moved it to Thursday, and I forgot to change a reference or two. So it is Thursday, May 29th. The question I have to pose to the boards is, do you want to make a motion to amend that to 1 o'clock as opposed to 2 o'clock? Because it's going to be a long meeting. We have the financial statements, the actuarial reports, the budgets, and then Pedro also doing a legal update and providing all the securities litigation monitoring information. We already have that meeting at 2 o'clock just because we know it's a long meeting every year, but now we're adding that extra. I don't know how long the securities litigation depends on how that conversation could be 15 minutes or it could be an hour itself. So
Is everybody comfortable with 2 o'clock, or do we feel need to move it back to 1 o'clock? please.
Or two. Yeah, I'd rather have one for, just make sure you
One.
get one right here till 5:36.
Fire. All right, one. Okay. I guess do we need to make a motion on that to?
Yeah.
Let's make a motion in a second to move it to 1 p.m. on Thursday, May 29th, 2025.
I believe so.
Individual boards.
Please make some motion.
Second.
I got a first and a second. Madam Clerk, roll call.
David Cohill,
Yes.
John Patridge,
Yes.
Matthew Grocki,
Yes.
John Gostilla,
Step down.
Jason Sharp.
Yes.
Motion carries. Firefighter. Motion and second.
Second.
Madam Clerk, roll call.
George Candler,
Yes.
Ed Dawson,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes.
A motion carries. General employees first. A motion and second.
Motion to approve.
Second.
Madam Clerk, roll call.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Jennifer Rotolo.
Yes.
Motion carries. So Thursday, May 29th, 2025, we will begin at 1 p.m. for the court. That's the annual meeting, correct? Annual meeting.
Sorry.
That's the big meeting, the annual. meeting.
Yes.
Okay. Anything more for the good of the order? All right, can I get a motion second for adjournment?
Motion to adjourn.
Second?
Second.
So carrying, we are adjourned.